This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
So I closed out last month on the real estate side, sold 3 houses, got 2 more under contract. So it's been a long time coming, but all that stuff that Jason and the rest of the team and I have been working on since Jacksonville, all coming through. So all good stuff.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, empowered investors. This is episode 2236. Thank you so much for joining me today, and greetings from beautiful Mexico City. If you are watching this on video and you think I am using a virtual background, you would be mistaken. This is a real background. I know it looks kind of Hollywood in a way. It's pretty cool the way the lighting hits and so forth. Anyway, no, this is my cool little penthouse in Mexico City that I've had for the week, and just looking around the city, doing some work from here and all that kind of stuff. Last night, I attended the Corona Capital Music Festival for the second of 3 days that it ran. I got to see Paul McCartney, got to hang out with Beck backstage and drive over to the event with him. And that was really, really super cool. It was a great time. Lots of bands, lots of fun. It's interesting, around the world to just see how differently a music festival or a concert is run in Mexico versus the US or Europe or anywhere. So that was just a great experience and really enjoyed it. Okay, so we've got some good stuff to get into today. First of all, I will tell you, it is interesting watching the Trump administration form. The cabinet picks, I think, so far are pretty darn good. I am most excited, though, not about any of the picks you've heard of. I'm most excited about the flagship 2 guys, the Elon and Vivek team for DOGE, the Department of Government Efficiency. And I am just so optimistic about what they're going to do, because it's not only about the money they will save us, the money they will save the taxpayers, the money they will save the country, but it's also about making government better. Just millions of people. These people hiding in their government jobs have basically made us the victims of their Peter principle, right? They've risen to their level of incompetence a long, long time ago, and we are all suffering for it. I mean, how many times have you called or tried to get assistance from a government office and you dealt with some bureaucrat who didn't care? They get paid anyway. Imagine how much better they will get when they are, number one, incentivized. Number two, they see so many of their colleagues getting layoffs, getting pink slip, because the government is no longer going to be this bloated, just ridiculous, terribly inefficient entity that it has been. It's going to take these guys a while, but they're going to do some really good stuff. I have a lot of faith in this, and I'm very, very excited about it. And this will allow the government to spend money on more important things, or to just lower our taxes and stimulate the economy that way. Either way, we're all going to win. Everybody is going to win from a more efficient government. And interestingly, the people who have been hiding out in their jobs, just getting away with being lazy sloths, they will actually win too. Because, when you take a government job, you tend to lose your edge. You tend to become an inferior version of yourself. Whereas if you had to compete in the free market, you become better. I mean, you just get better, right? You get better, you get on your game, you're more attentive, you take better care of customers, you take better care of everybody you deal with, all your stakeholders. So this is going to be a great thing, folks. Just mark my words. Really, really excited about this. But inflation is the watchword of the next 4 years, really of the decade, really probably of the next couple of decades. Into the 2040s, we'll probably see a change, but boy, we got a lot of debt and it's rising fast and it's going to keep rising for quite a while. And here is an article about housing, right? Rising housing costs are creating sticky inflation. Inflation is a very sticky thing. Well, overall inflation has moderated significantly. Donald Trump's election victory clouds the future, right? And look, everybody keeps asking me, and I keep really thinking a lot about it myself. Well, what would you have said differently if Kamala won when it comes to inflation? It's really kind of the same. I don't think the advice changes too darn much with, a Republican or Democrat victory, but either way, inflation is the watchword. And I've taught you for the last 21 years how to profit from inflation significantly. So again, it's not great overall for society by any means, but it is great for you as a real estate investor. A really, really great opportunity for you to profit from inflation. And inflation is going to be with us for quite a while. Of course, when I say that, that doesn't mean that if I'm projecting real estate prices or inflation rates out into the future, it doesn't mean that there will be little bouts of ups and downs. Of course there will. I'm just making the big macro projection, right? The big macro prediction or forecast. And that is the way you should invest. As income property investors, we don't invest day to day. We don't watch stuff day to day. We invest for the big macro mega trend, and that is how we profit. That is definitely how we profit. So speaking of which, of course, we run a nationwide referral network where we can help you buy properties in markets that we like from teams and providers and sellers that we like, that we recommend. And again, this is a very dynamic thing. I cannot tell you the number of times, almost every time, in every one of the hundreds and hundreds and hundreds of relationships that I have had with different providers over the years, over the 21 years I've been doing this. They all start out good, and then we refer them a lot of business, and then they get very busy, and the service starts to suffer, the communication starts to suffer, and then they usually move into the ungrateful mode. Whereas at first, they're totally grateful. They say, Jason Hartman, you changed my life, right? You have given us so much business. It's so great. And then it goes into the too busy mode where they just can't handle the business. And then it goes into the ungrateful mode. We don't need you type mode, and we don't care about your clients and your referrals, right? And so this is a dynamic thing. And that's why we are always changing and recommending the new providers, the new best local market specialist in any given market at that time. So if you're one of our thousands and thousands of past clients, always check with your investment counselor, check in with us as to who we're referring at the time, because things are always changing. Markets are changing. Teams are changing, sellers are changing, developers are changing, local market specialists are changing. It's all a dynamic thing. So keep in touch with us and let us guide you and let us help you. So here's an example of just one of many properties we have. You'll find it at jasonhartman.com on the properties page. This is the 1-year projection on brand new construction. This brand new construction, so you're starting out great. This is in the Birmingham metro area, Birmingham, Alabama metro, 1,837 square feet, $420,000. And initial cash invested in this projection is about $119,000. You're buying this for $229 per square foot. And as you can see, if you're watching on video, the spec level is excellent. I mean, look at the finishes, look at the elevation on these properties. These are great, great looking properties. Your monthly rent projection per square foot is $1.82 per square foot. So that brings your overall gross rent projected at $33.50 per month. So here you've got an A-class property. You're starting out with a brand new property, so no concerns about maintenance, and you're going to get A-class tenants most likely in a property like this. This is a really nice Class A property. Now, these pro formas that you're seeing on the screen if you're watching on video, you can make these yourself. Just go to propertytracker.com. That is our software company. And when I bought the company several years ago, I decided to make it free. Okay, it is free. Now, you can upgrade your plan, of course, but you don't have to run these performas and really use the best real estate evaluation software in the industry. This is it. Property Tracker. Okay, go to propertytracker.com, get your free account if you don't have one already. So here we're projecting 25% down. And again, these are higher rates today. So nothing's as good as it used to be, folks. It's not as good as it used to be. And here you've got 6.75% interest. Let's go to the next page. What I did is I took this one-page projection and I split it up. So I blow it up on the screen for you. You've got your property taxes, your insurance, your management fees. And again, we recommend self-management, and we will help you do self-management to get optimum performance out of your properties. But if you don't want to do self-management, we refer you to our recommended property managers. You can use whoever you want. It's your property, but we will recommend you, and we will help you oversee that relationship. So your NOI, your net operating income on this property, is projected at just over $2,200 a month. And your cash flow projected at $455 per month positive cash flow. I mean, that's phenomenal. This is getting close to $6,000 a year in positive cash flow on this property. Your first year appreciation with the 6% appreciation standard that we have in here is $2,100 in appreciation. Gross equity income, just over $2,500. You've got some tax savings in there. And then your debt coverage ratio, 1.26%, and just going down to your overall return on investment projected at 26% annually. And that's based on a cap rate of 6.4%. So this looks pretty darn good. I mean, as I always say, if it only goes half as well as expected, would you be happy with a 13% annualized return on investment on your property? Of course you would. Nobody would say 13% annually is disappointing, right? But it might be twice as good. If we get a Trump bump, it might be 3 times as good. During the COVID era, our investors saw these projections blown out of the water. They were so much better than expected. It was phenomenal. So again, we can help you buy properties like this. We can help you build a whole portfolio. We've got some clients that have got a portfolio nearing 200 properties. We've got some clients that just buy 1 property per year. Okay, so wherever you are in your income property journey, we want to help you create that solid financial future and really insulate yourself from the inflation that is going to persist for a very long time to come. You know, it's a multidimensional asset class. I mean, people say, well, how can you get, if they don't understand how to do the math? And that's why I really recommend that you use the software. Okay. Understand how to do the math. If you want a 30-minute video on this, it's totally free. Go to jasonhartman.com. Right on the front page is the video that goes in deep to every single number on these performas, helps you standardize your data. And that's all at jasonhartman.com, right on the front page. Just watch that free video. And, I really recommend everybody watch that video every 6 months or so, just to remind them how to focus on the numbers and how to really do the math on an income property. But it's a multidimensional asset class. So you earn your return on investment in many, many ways. And that's why a 26% ROI, because you're using some leverage here, is very realistic. I mean, look at the assumptions we're making. Only 6% appreciation. We're assuming a vacancy rate. A lot of these other cheesy promoters out there that you might have come in contact with, they'll assume no vacancy. That's not true. Real life properties, you have vacancy. We're assuming 1 month per year. We're assuming a management fee of 8%. You could self-manage and do much better than that. Assuming maintenance. This is a brand new home. This is a brand new investment property. So you probably have 0 maintenance your first couple of years, but we're assuming 2%. Conservative projections with conservative assumptions, and still an overall return on investment projected at 26%. Our investment counselors can talk to you about this property or properties in any of our other markets, whether they be Indiana, Tennessee, Florida, Alabama, Arkansas, whatever. We've got properties all over the country in many, many markets. So touch base with our investment counselors through jasonhartman.com, and we will be glad to assist you in building a fantastic income property portfolio. Okay, let's get to our main part of the content today. What I wanted to do is share a recent Zoom that we had where I am teaching one of my core techniques. There are a few core techniques that I really, really focus on, and it's really important that we always come back to this core content. So let's take a look at that right now. Okay, let's talk about the Hartman Risk Evaluator. Now, this is something that I discovered, and it's totally new thinking. You haven't heard it anywhere else before. It came out of my own head. It is something that can really help you reduce risk when investing. It can really help you mitigate any downside risk you might have. Basically, look at it like this. Remember, when you buy a property, you're not buying one thing. You're not buying a property. You're buying two things. You're buying land, and you're buying what's sitting on the land, the house, the apartment, whatever it is, right? So the land and the improvement, those two things. And what's interesting, and I was going to update this, but I decided to keep it original because it's really telling as to how things were when I first presented this stuff back in 2004, okay? So remember, the improvement value, the cost to build plus the builder's profit, right? That's what goes into the equation. The cost to build plus the land cost and the builder's profit, that's what dictates our end cost of that property. So what affects and increases the value of the improvement sitting on the land? Well, environmentalism and building restrictions. And these get more and more restrictive every year. And any builder will tell you that. There's an old riddle. What do you call a developer? The answer, someone who wants to build a house at the beach or in the woods. What do you call an environmentalist? Someone who already owns a house at the beach or in the woods, right? And that's the old NIMBY thing, not in my backyard, right? Once they've got theirs, they want to keep everybody else out. When I interviewed Thomas Sowell on my show years ago, he's like episode number 115 or something, brilliant man. As I was interviewing him, I actually coined the term environmental racism, because that's what happens in any given area. As soon as people move in there, they go to the city council meeting and they're anti-development. They want to, dedicate this land next to where they live as permanent open space, right? That can never be developed, right? And all this kind of stuff. So these building restrictions just get more and more intense over time. And that increases the value of improved property because it can't be replaced again. It can't be duplicated because nobody's allowed to improve on it. Or if they are, they got to do 30 million environmental impact reports and spend an absolute fortune to do it. And it becomes cost prohibitive. Okay. Industrialization of developing countries. So I'm going to show you a picture of a house I'm going to talk about that I purchased years ago. And when I purchased this house, I had already purchased many, many homes before this. And I moved into them, and they were in Irvine and Newport Beach. And, whenever you bought a new home, the developer would never include the landscaping. So I would always have to landscape the house. And I got very good at managing landscaping projects and getting bids from contractors and hiring contractors and all that kind of stuff. And I remember this one house that I'm about to show you. I couldn't believe how expensive the bids were on the landscaping job. Now, granted, the yard was pretty big, but it was really expensive. And I kept asking the contractors, why is the price so high? I'm not used to paying this much. And they all said, China, 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 China. And I'm like, what? And they said, well, China is sucking up all the world's concrete and other building materials. And so it's making it very expensive. It's pushing the prices of our concrete up. There's like a concrete shortage as China was industrializing and building highways and buildings and ghost cities. And, we all know the story about China, okay? And so that industrialization around the world, as people are lifted out of poverty through globalization, there's goods and bads of this. So I get it. That's a long discussion. But the fact is, they're sucking up building materials like crazy. So that increases the cost of building and of improvements, okay? Raw materials cost. Look at this. 2004, I left this alone. I didn't change it, okay? This is the original. 2004, inflation was 3.3%. That was the official rate of inflation by the CPI, right? But at the same time, steel and iron prices were up 34%. Lumber, we certainly talked a lot about lumber in the past year and a half and lumber prices. Lumber was up 17% that year. Prices of gypsum or wallboard, 20% increase, right? So amazing increases that were completely untethered to inflation. And then, of course, there's labor cost. And of course, there's energy cost, right? Energy is in the cost of everything, right? It's in the cost of this phone. It's in the cost of everything, right? And so energy costs, when they go up, they certainly impact building cost as well. Okay, so here's the house I want to talk about. Here's a couple pictures of it. I lived here for 7 years. It was the longest house I ever lived in, okay? Not a childhood house, but an adult house, right? And that's my old dog, Puppy. When I was looking up these pictures, I saw his pictures, so I thought I'd share that too. Anyway, this house was a premium house for the neighborhood. You know, you don't get much in Orange County. It's a pretty expensive market. And so adjust for inflation, this was 2004, I bought this house. I paid $815,000. The house now is worth about maybe $2 million or so, okay? And the thing that's different about this is that my lot, I knew the developer, okay? You know, he was the son of Donald Bren, who owned the Irvine Company, and his son, Kerry Bren, was actually a client of mine and a friend of mine. And so he let me pick my house early, and he did that for me a few times. Very nice favor. And so I got to pick the first lot in the whole development. And I wanted to pick this premium lot. It's the best lot in the entire development. If you're familiar with Orange County, you know that this yard is considered huge in Orange County, okay? So, you know, usually they're little postage stamp yards. And so I picked this lot, and the lot premium was $90,000, which at the time I thought was an absolute fortune, okay? And my girlfriend at the time, Monique, tried to talk me out of it. And, you know, her mom was in new home sales, and so she knew something about it. And, you know, she tried to tell me that was just ridiculous. I shouldn't do it. I was overpaying, blah, blah, blah. Anyway, we broke up and I bought the house. Okay, so here's the way the house looked when I bought the house. This is a copy of my tax bill. Now, why do I show you the tax bill? Because the tax bill parses out the improvement cost and the land cost. So let's take a look at that. Here it is. House was $815,000, okay? And according to the tax collector, John Morlock, they said that the land was worth $660,000, roughly. The buildings or the improvements, $156,000. So total up to about $815,000. Now, why do I show you that? Because we can dramatically reduce risk when investing if we understand the equation that I coined the term LTI. You've all heard of LTV, which stands for loan to value ratio. LTI stands for land to improvement ratio. I made that one up, okay? The LTI ratio. And the LTI ratio is your risk mitigation strategy. All right, so there are a few ways you can know what the LTI ratio is of a property. You can look at your tax bill like we just did. You could have an appraisal, or you could get an insurance policy, and your insurance company will know the LTI ratio. Now, this is how I discovered this, by the way. I was buying a property, well, I was buying two properties at the same time. One of them was this property, and the other one was one of my first out-of-state properties. I was buying this property across the country. And the property I was buying across the country was $159,000. The property I was buying to live in was $815,000. And I was buying these right around the same time. And my insurance agent, Jennifer, who was in Irvine, called me up and said, hey, Jason, we've got the policies, and here's the deal on the policies. We'll insure your out-of-state property for $135,000. And we'll insure your Orange County property, your local property, for $156,000, okay? Now I thought, wow, the Orange County property is so much more expensive than the rental property out of state. And yet the amount of insurance I'm getting is about the same. It's not too far apart because they're only insuring the improvement, the structure, the house sitting on the land. Remember, the land can't burn down. The house can. They only give you insurance on the improvement. So what dawned on me when Jennifer said this is I thought, wow, look at the ratios of these two properties. And I coined that phrase LTI ratio. So you're buying the improvement and the land. Okay, well, let's look at how that parses out. On the house I was buying to live in, 100% of the value was about $815,000, and 81% was land value, about $660,000. 19% was improvement value. Okay, great. So what? Let's keep going. Now, about a year later, that property went way up in value because the market was going nuts then. The money was cheap. Alan Greenspan had just massively lowered the interest rates after the dot-com bubble in 9/11, and there was still this hangover, and lenders were giving loans to anybody who could fog a mirror. Okay, it was ridiculous. I used to show on my presentations back then screenshots of emails I got, and we used to still get faxes back then, screenshots of faxes I got on my JFax or eFax account. And they would say things like, one day out, because I owned a mortgage company back then. So this is why I would get, I would get these from what's called the wholesale lenders. I would get their rates, and we would be a retail lender and we'd make the loans, right? So they would say like the parameters for the loans. They would say 1 day out of bankruptcy, 1 day out of foreclosure, FICO scores 580 or above, nothing down. They're just ridiculous loans that no sane person would make, right? So years before the crash happened, I predicted the crash would happen. And I would get in these vociferous arguments with realtors who would just hate my guts in Orange County because I was doing these seminars just locally in Orange County at the time. And, realtors would come and they'd like argue with me. No, the market's not going to crash. You're an idiot. And, of course I was right. But, that at the time, it didn't seem like I'd be right. Okay. So the question is, this property goes to $1.3 million a year later. Absolutely insane appreciation. $485,000 in appreciation in a year. And I'm thinking, God, do I love real estate? This is the greatest thing ever. But I called the lender and I said, I want to refinance and pull cash out so I could buy more rental properties. They said, sure. They send an appraiser over. His name is Eric. And I'll tell you about Eric in a minute. The appraiser appraises the property. Congratulations. Your house is worth $1.3 million. I'm like, that's awesome. Great. So I refinance, I pull cash out, I buy more rental properties around the country, all is well. But again, a year later, the rates went down. And I called the lender again and said, I want to refinance again a year later. They send the same appraiser over, Eric. He comes over again. And he says, I have bad news for you. Your property, I'm only appraising that for $1,215,000. So here's the question. So it went way up in value. Of the two components, what went up? Land or improvement or both? They actually both went up, okay? But mostly land. Most of the increase in value was in the land. Now, why did the improvement go up? Because of China, the building costs, right? They did go up, and we saw that. But they didn't go up $485,000. Most of that was in land value. So what I realized here, when the second refinance was done, when the value went down, I thought, well, now what went down, the land or the improvement? So that's the second question. What went down? The answer is land. It was probably actually still a little more expensive a year later to build the house again, just slightly maybe. But land went down. So the risk area is in the high land value markets. Now, you know my teachings about linear, cyclical, and hybrid markets. How do you know if something is a linear market or a cyclical market? Easy. High land value or low land value. If it's a high land value market, it will always, no exception, be a cyclical market. And if it is a high improvement value market and low land value market, it will always be a linear market. There aren't any exceptions to this that I'm aware of. So that's how you know what kind of market you're in, okay? So the risk area is in high land value markets because land has no intrinsic value like improvements do. Improvements are simply packaged commodities. So, I'm in my house, and if you look behind me, you see drywall. Inside the drywall is copper wire. There's lots of petroleum products in the house. There is lumber. There's concrete block. Over here, I see glass, steel, all of these commodities. And these commodities are not indexed to any one currency. They have intrinsic value that every human needs. Everybody needs shelter. Everybody needs these commodities. And they are not indexed to any one currency. They're traded globally, and they're needed by everybody around the world. So it's much easier to value those commodities because they're actually traded on the commodities market than it is to value land. Land is much more wishy-washy. It goes up, it goes down, it goes up, it goes down, right? You just don't know. So if the risk area is in the high land value markets, then how does this inform our investment strategy? Like this. You want to have a floor in your investments, and the floor is low land value and high improvement value. So let's go back to that out-of-state property I was buying. Remember Jennifer? She said, Jason, we're going to insure the rental property for $135,000. Now, you remember what I paid for it? $159,900. So that means by deduction, the land value was only $24,000 over here. The improvement value, the house sitting on the land, $135,000, because that's what she said they would offer in insurance. The improvement could burn, it could flood, whatever. That's the insurance on the improvement. The house in Orange County, on the other hand, super high land value. Actually, at the peak, the land value was $1.1 million. The improvement, I'm going to value at $200,000 when they said 1.3 for the whole thing. So what happens? If the land drops by half on the Orange County house, I'm going to lose $550,000. If the land drops by half on the rental property out of state, I'm going to lose $12,000. How do you want to invest now? Much lower risk, much more conservative investment when you're buying the properties in low land value, linear. And I don't even know if there is a such thing, frankly, as a linear market in today's crazy world. They're all kind of hybrid almost, but close enough for government work, close as we're going to get, right? So low land value markets are the answer.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.